You might have heard investors mention the P/E ratio when talking about stocks, but if you're not exactly sure what it is, don't worry, you're not alone. The P/E ratio, or price to earnings ratio, is one of the most talked about numbers in investing, yet many people don't really understand what it tells you, or more importantly, when it can steer you in the wrong direction. Today, I'll explain exactly what the P/E ratio means, how to use it properly, and when you should just ignore it. By the end of this video, you'll know exactly how to use this tool the way professional investors do, so let's get started. The P/E ratio is a simple way to measure how expensive or cheap a stock is relative to its earnings. You calculate it by taking the stock price and dividing it by the company's earnings per share, or EPS. Earnings per share is just a way of measuring how much profit the company makes for every share of stock. So for example, if a company's stock price is $50 and its EPS is $5, the P/E ratio would be 10. That means investors are paying $10 for every $1 the company earns. At first glance, this might sound like an easy way to judge whether a stock is a good deal or not, but as we'll see, there's a lot more to it than just a simple calculation. People use the P/E ratio because it seems like an easy shortcut to evaluate a stock. A lower P/E might suggest the stock is undervalued, meaning it's cheap compared to how much profit the company generates. On the other hand, a higher P/E often signals that investors are willing to pay more for the stock because they expect the company to grow in the future. It's similar to shopping. If you see two similar products, but one is twice as expensive, you might assume the pricier one is better quality or will last longer. The same logic applies to stocks. Investors are essentially pricing in the company's future potential, but as straightforward as this sounds, it's important to remember that the P/E ratio is only one piece of the pie. While the P/E ratio can be helpful, there are many times when it's misleading or completely useless. For starters, companies can manipulate their earnings to make their P/E ratios look better. For example, they might sell a major asset or make short-term cuts to boost profits temporarily. In cases like this, the P/E might look low, but the earnings that created it aren't sustainable and the stock could become more expensive in the long run. Then there's the issue of negative earnings. If a company is losing money, it won't have a P/E ratio at all. That doesn't mean the company is a bad investment. Startups like Tesla in its early days had no profits for years because they were reinvesting heavily to grow. Another problem is that P/E ratios vary drastically across industries. A tech company with a P/E of 40 might be fairly priced if it's growing rapidly, but a utility company with the same P/E would look absurdly overvalued. You simply can't use the P/E ratio to compare companies in completely different sectors. Without context, the P/E ratio is solely a number. So how should you actually use the P/E ratio? The first step is to compare it to similar companies in the same industry. For example, let's say you're looking at a tech stock with a P/E of 35. If other tech companies in the same space have P/Es around 20, you need to ask yourself if this stock's higher valuation is justified. Is it growing faster? Does it have a competitive edge? If the answers are yes, the higher P/E might make sense. If not, it could be overpriced. Another way to use the P/E ratio is to compare it to the company's historical average. If a stock normally trades at a P/E of 15, but is now trading at 25, something has changed. That doesn't automatically mean the stock is overpriced. It could mean the company has entered a new growth phase, but it's a sign you should dig deeper. Finally, for high growth companies, it can be useful to look at a metric called the PEG ratio, which adjusts the PE for the company's growth rate. A stock with a P/E of 30 might seem expensive, but if it's growing earnings at 40% a year, it might actually be a bargain. There are also times when you should entirely ignore the P/E ratio. One of the biggest examples is with high-growth startups. Companies like Amazon or Tesla in their early days often had sky-high P/E ratios or no P/E at all because they were reinvesting every dollar back into the business. For these companies, focusing on revenue growth or market share tells you more than the P/E ratio ever could. Another example is during market crashes. In times of extreme volatility, earnings across the board can drop, making P/E ratios temporarily meaningless. The market trades on fear, not fundamentals, during these periods. Finally, turnaround stories can also render the P/E ratio irrelevant. If a company is undergoing massive restructuring, its past earnings might not reflect its potential, and the P/E won't give you the full picture. In all of these cases, you'd be better off looking at other metrics or qualitative factors. So there you have it. The P/E ratio is a useful tool, but it's far from perfect. It's great for getting a quick sense of whether a stock is expensive or cheap compared to its earnings, but context is everything. And remember, there are times when the P/E ratio just doesn't tell you the full story. If you like this video, please subscribe and leave a like. Thank you for watching this video. Until next time, stay tuned.